If you've ever heard the term AMT and thought, I'll deal with that later, this video is absolutely for you. Because if you're exercising incentive stock options or planning to, AMT can sneak up and hit you with a massive surprise tax bill. But I'm not here to scare you. I'm going to break it down so it makes sense, walk you through a real case study, and show you how to avoid the AMT traps, and even recover some of it in later years. So let's dive in now. So why does AMT exist? It turns out that the government actually likes when people do certain things. They love it when you invest in startups. You create jobs, you explore for minerals like oil, build housing, and generally take risks that help the economy grow. So the IRS simply gives tax incentives to encourage those behaviors. And one of those incentives is called incentive stock options, the ISO. The incentive part means grow your company, take the risk, and we'll reward you with long-term capital gains instead of ordinary income. This is a huge tax break, but the IRS still wants to make sure people pay something, as this is a pretty big incentive. So they created a backup tax system called Alternative Minimum Tax, AMT. It's a second calculation to make sure people using lots of deductions, tax breaks, and incentives like ISOs to still pay their fair share. That's AMT in a nutshell. Before AMT makes sense, you have to understand the normal system. The regular tax recipe looks like this. So your regular tax, you start with all your income. This would be your salary, RSUs, any side gigs you have. Then you subtract the above the aligned items like your pre-tax 401k contributions. Then subtract either the standard deduction or your itemized deduction, which includes things like mortgage interest or charitable giving. What's left is your taxable income. You apply your tax brackets, which are progressive, and go up to 37%. Then you subtract credits, things like that nice electric car that you bought in the past. And finally, you get your final regular tax bill. Kind of straightforward, with lots of ways to reduce your tax bill, which is exactly why the IRS built the backup system. Enter calculator B. AMT starts with the same income, but then it changes the rules. Here are the AMT steps. Start with your regular income again. Now you add back things. The normal system lets you deduct, like ISO spread, accelerated depreciation, private activity bond interest, and you cannot take a standard deduction or things like a SALT deduction, which is your state and local taxes. So this gives you your AMTI, which is your alternative minimum taxable income. You then get to subtract the AMT exemption, which is phased out at higher income levels. You apply a flat 26% or 28% rate, which is the maximum. This gives you your AMT tax liability. The next step is you compare that total to your normal tax. You pay whichever is higher. If your AMT is higher than your regular tax, you have AMT tax due. That's AMT. Now, let's connect all the theory we just covered with some real math. You've heard me talk about the ISO spread, AMT exceptions, and how regular tax and AMT tax run in parallel. But what does it actually look like on a tax return? Let me show you. We're going to look at a simple spreadsheet that compares your regular tax calculation, your AMT calculation after exercising your ISOs. This is based on a common scenario I see all the time with clients. Now, a quick disclaimer. This is illustration example only. Always consult a qualified tax professional before acting on this. So here's the setup. We have a mid-career tech employee making a $250,000 a year salary. And they go in there and they exercise 10,000 shares at a strike price of $1 with a fair market value at the time of exercise of $15. Remember, the difference between the fair market value and the strike price times the amount of shares gives you your bargain element, i.e. the spread. So we pull this all down and we start calculating the regular income tax by putting their salary in, taking a standard deduction, getting your taxable income, applying the tax tables to see that they owe a regular tax bill of $38,133. AMT on the other side, we take the same income, we add back that bargain element, i.e. the spread, we take a AMT exemption of $137,000, get taxable income of $253, apply the flat rates, and you see an AMT tax liability of $66,058. This seems normal so far, right? But here's what happens. That's a $27,925 AMT bill just for exercising ISOs. No sale, no capital gains, just a tax bill out of nowhere. So now let's model two more scenarios. One where the ISO spread is small and the AMT doesn't kick in, and one where the spread is big and the AMT explodes. This way, you'll see exactly how sensitive AMT is to when you exercise, the company's 401(a) valuation, and whether you're exercising early versus late in the year. So let's jump back into the numbers. So scenario 2, you can pre-exercise. So you go in there and exercise your 10,000 shares, the strike price $1, when the company's still worth $1. Therefore, you have no bargain element. You can see your regular tax is calculated below, and then your AMT is calculated here, but there's no add back because you exercised when it was $1, when it was worth $1. So you have no AMT due on this exercise. Now imagine your company is being acquired, are going to go public, and the valuation explodes up to $70 for this same grant. So you put 70 in for the company value, and you see your bargain element grows to 690. It's added back in AMT, and now you owe an AMT payable bill of $181,925, which is a surprise if you are not prepared. Now, one more scenario is I want to show how you can leverage that AMT exemption to your benefit. So let's go back in and set the price at 15. We know we have an AMT bill of $27,925. So let's say we exercise half of our grant, $5,000. That drives down our bargain element to $70,000. That's still an AMT bill of $9,447. So let's continue to drive that down to 2,000 units. Now, you can see that by just exercising 2,000, you have a bargain element of 28,000, which is added down here, but it results in a lower AMT breakdown. So you have no AMT payable. So essentially, you were able to exercise 2,000 shares with no tax liability. This is maximizing your AMT exemption. So with that, let's jump back into the deck. Before we go deeper into strategy, let's pause and simplify what's actually happening here. You're not doing one tax return, you're doing two, side by side. Let me show you the analogy I use with clients. You got two calculators on your desk. Calculator A is your calculator, which calculates your regular tax, and this includes deductions like mortgage interest, SALT, and comes out to $48,000 of taxes. Now, calculator B, this is the AMT calculator. It adds back all the stuff you deducted. No standard deduction, no SALT. A flat rate's applied, and it comes out to $78K. The IRS says you pay the higher one. That's AMT. So how do we avoid this? Here are the 5 biggest levers to avoid an AMT disaster. Tip 1, know the AMT add-backs. The biggest AMT trigger is your ISO spread, fair market value at exercise, and your strike price. If you don't know the spread between those, you're simply flying blind. Tip 2, time your deductions strategically. In an AMT year, deductions like charitable giving, mortgage interest, property taxes, state income taxes, they don't help you too much. They simply lower your regular taxes, but not your AMT, making AMT more likely to apply. Think of AMT like a rock. So here's your rock, and here's the river. When the water is high, which is your regular tax, the rock is covered. Now, lower the water too much via deductions or not enough ordinary income, and the AMT rock pops above the surface. Instead, bunch deductions into a non-AMT year or accelerate income into this year to stay out of AMT. Tip 3, exercise ISOs early in the year. If the stock price drops after you exercise, early year exercises give you time to sell. Selling disqualifies the ISO and turns it into an NSO. That means the spread, which is that gain, becomes ordinary income, not AMT add back. This is downside protection. Huge warning, if you exercise and the calendar year ends and the stock tanks, the IRS does not give you a break. You still owe AMT based on the stock's value when you exercise, even if it's worth way less now, maybe even zero. Quick note, I'm not going to deep dive into ISO versus NSOs in this video, but if you're not sure what a disqualifying sale means or how ISOs and NSOs are taxed differently, check out my channel, Nagy Knows Money. I've got a few videos that break it all down step by step. So let's jump back in. Tip 4, use your AMT exemption before it phases out. Your AMT exemption acts like a standard deduction in Calculator B, but it's use it or lose it every single year. If your income is below the AMT threshold this year, you might be able to exercise your ISOs with zero AMT owed. Most people miss this. A small strategic exercise can lock in future long-term gains tax-free. Tip 5, track your AMT. If you do pay AMT, don't panic. You might recover part of it later through the AMT credit. How it works, You pay AMT this year. In future years, if your regular tax is greater than AMT, you get a credit for the difference, and it carries forward until it's used. This can take years, so ask your CPA, are we filing Form 8801 to track my AMT credit? How much credit do I have? How long until it's fully recovered? Do call out. Most software misses this unless manually flagged, so check, please. You now understand AMT better than 99% of tech employees. AMT isn't a punishment. It's simply that second calculator. But if you don't understand how it works, you can make one move, one ISO exercise that creates a pretty nasty tax surprise that may not be recoverable. Don't let that happen. Please consult your tax professional. And if you want help building an AMT safe equity strategy, reach out. I'm Jonathan with Alpine Road Financial, helping tech professionals like you turn your equity into more trail days. See you in the next video.